IAS 16, Property, Plant and Equipment. That is our lecture for today. Welcome. IAS 16 is an international accounting standard that dictates the accounting treatment for property, plant and equipment, PPE. Its main objective is to provide users of financial statements with information about an entity's investment in PPE and the changes in that investment. By the end of this lesson, you will understand what assets fall under IAS 16, when and how to recognize them, how to measure them, and the presentation and disclosure requirements. Scope of IAS 16. IAS 16 applies to fixed tangible assets that are held for use in producing or supplying goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one reporting period. Examples are buildings, machinery, office equipment, and vehicles. IAS 16 does not cover assets held for sale, biological assets, intangible assets like patents, mineral rights, and reserves. Remember, PPE is tangible long-term assets used in operations. Recognition. For an item to be recognized as PPE, two conditions must be met. 1. It must be probable that future economic benefits will flow to the entity, and 2. Cost can be measured reliably. Measurement. Initial measurement. At recognition, PPE is measured at cost. This cost is made up of the purchase price, directly attributable cost, less discounts and rebates. Directly attributable costs are costs necessary to bring the asset to working condition for its intended use. This would normally include cost of site preparation, delivery and handling, installation, related professional fees for architects and engineers, testing and professional fees. Do not include general administrative overheads, opening ceremony costs, staff training costs, among others. Subsequent measurement models. After initial recognition, IAS 16 gives two options, the cost model and revaluation model. Under the cost model, the asset is carried at cost less accumulated depreciation and impairment losses. This is the most common model in practice. Under the revaluation model, the asset is carried at fair value at the revaluation date, less subsequent depreciation and impairment losses. Revaluation must be done regularly, so carrying amount doesn't differ materially from fair value. Increases go to revaluation surplus unless reversing a previous decrease. Decreases go to profit or loss unless reversing a previous surplus. If one asset in a class is revalued, all assets in that class must be revalued. Depreciation. Depreciation is a systematic allocation of depreciable amount over useful life. Start depreciating when the asset is available for use. Stop when derecognized or classified as held for sale. Review useful life and residual value annually at the reporting date. Depreciation methods include straight line, reducing balance, and the units of production. Choose the method that best reflects consumption of economic benefits. Subsequent expenditure. Enhancements or major inspections. Enhancements and major inspections should be capitalized if they increase future economic benefits. Significant parts or components are required to be depreciated over their estimated useful life. Cost of replacing components are required to be capitalized. Continued operation of an item of PPE may require regular major inspections for faults regardless of whether parts of the item are replaced. When each major inspection is performed, its cost is recognized in the carrying amount of the item of PPE as a replacement if the recognition criteria are satisfied. For cost relating to repairs and maintenance, expense immediately. Derecognition. Remove an asset when it is disposed of, withdrawn from use, or no future economic benefits are expected. The gain or loss on disposal is calculated as the net disposal proceeds less carrying amount. This is reported in profit or loss. Presentation. Assets are shown on the statement of financial position under non-current assets. Depreciation expense and disposal gains or losses go to the statement of profit or loss. Disclosure. IAS 16 requires extensive disclosures including measurement basis, depreciation methods and useful lives, gross carrying amount and accumulated depreciation, reconciliation of opening and closing balances, restrictions on title and pledged assets, if any. These disclosures ensure transparency for users of financial statements. Lesson summary: IAS 16 covers tangible operational long-term assets. PPE is recognized when it is probable that future economic benefits will flow to the entity and the cost can be measured reliably. An item of PPE is initially measured at cost and then cost model or revaluation model. Depreciation is a systematic allocation of depreciable amount over useful life. PPE is shown under non-current assets in balance sheet. The disclosure requirements for IAS 16 includes measurement policies, movements, and key details. That is IAS 16 in a nutshell. See you in our next lecture, IAS 36, Impairment of Assets.